The United States, as the world's largest economy, is also the world's largest debtor nation. As of 2024, the national debt exceeds $33 trillion, raising critical questions about its sustainability and whether it can be fully repaid. The issue is complex, involving economic principles, political realities, and global financial systems. This video explores the factors contributing to the American national debt, the implications of its size, and whether repayment is a realistic possibility. What is the national debt? The national debt is the total amount of outstanding borrowing by the U.S. federal government accumulated throughout the nation's history. The United States has had debt since its establishment. During the American Revolutionary War, the country amassed $75 million in debts, mostly borrowed from domestic investors and the French government for war materials. The American national debt is the total money the federal government owes to domestic and foreign creditors. It is primarily composed of two components: public debt and intragovernmental holdings. Public debt refers to money borrowed from investors, including individuals, corporations, and foreign governments, through Treasury bonds, bills, and notes. On the other hand, intragovernmental holdings are funds borrowed from government accounts, like Social Security and Medicare trust funds. According to top economist Paul Krugman, the U.S. doesn't have to pay off its mountain of debt. While individual borrowers are expected to pay off debts, the same isn't true for governments, Krugman argued in a column for the New York Times. That's because, unlike people, governments don't die, and they gain more revenue with each passing generation. Governments must service their debts, pay interest, and repay principal when bonds come due, but they don't necessarily have to pay them off. He said they could issue new bonds to pay the principal on old bonds and even borrow to pay interest, as long as the overall debt doesn't rise too much faster than revenue. The national debt has been growing steadily over the years due to budget deficits, wars, economic crises, and tax policies. When the government spends more than it collects in revenue, it borrows money to cover the difference, adding to the national debt. This borrowing has been particularly pronounced during economic downturns, such as the 2008 financial crisis and the COVID-19 pandemic, when massive stimulus packages were implemented to stabilize the economy. The sheer scale of the American national debt is staggering. As of 2024, the debt-to-GDP ratio, an essential metric for assessing the debt burden, stands at over 120%. This ratio indicates that the national debt exceeds the total annual output of the American economy. While this figure is alarming, it is not unprecedented. Many advanced economies, including Japan and several European countries, have similar or higher debt-to-GDP ratios. The size of the debt is concerning because making interest payments requires a large portion of the federal budget. If interest rates increase, these payments could also rise, putting more pressure on government finances. Without significant fiscal reforms, the national debt is projected to keep growing. The national debt is the total amount of money the federal government borrowed to cover its expenses over time. In a fiscal year, if the government spends more money than it earns, it results in a budget deficit. To cover this deficit, the government borrows money by selling marketable securities like Treasury bonds, bills, notes, floating rate notes, and Treasury inflation-protected securities. The national debt increases as the government borrows money to cover recurring deficits, leading to the accumulation of this borrowing and the associated interest owed to the investors who purchase these securities. Repaying the entire national debt is a challenging challenge, and many economists wonder if the U.S. can do so for several reasons. For debt to be repaid, the economy would need to grow faster than the debt. However, the American economy is unlikely to grow fast enough to reduce the debt-to-GDP ratio significantly without substantial fiscal adjustments. Even during economic expansions, the debt has continued to rise due to ongoing budget deficits. Over the past decade, the national debt has grown each year. During this time, interest expenses have stayed relatively steady because of low interest rates and investors' perception that the American government poses very little risk of default. However, recent rises in interest rates and inflation are causing an uptick in interest expenses. Efforts to reduce the debt face challenges due to politically unpopular measures such as raising taxes or cutting spending on popular programs like Social Security and Medicare. Inflation can decrease the actual value of debt over time, making it easier to repay. However, relying on inflation to reduce the debt is risky and could lead to higher interest rates and economic instability. Additionally, inflation can disproportionately affect lower-income households, exacerbating income inequality. The American dollar's status as the world's primary reserve currency gives the U.S. significant flexibility in managing its debt. Foreign governments and investors are willing to hold American debt because of the dollar's stability and the strength of the American economy. This demand for American Treasury securities helps keep interest rates low, making borrowing easier for the government. However, this reliance on global confidence in the American economy has risks. A loss of confidence could lead to higher borrowing costs and destabilize financial markets. The U.S. operates in a perpetual cycle of budget deficits, where the government consistently spends more than it earns. This cycle is driven by political pressures to fund public services, military spending, and social programs, often without corresponding increases in revenue. Breaking this cycle would require significant policy shifts that are difficult to enact in a politically divided landscape. While full repayment of the national debt may be unrealistic, its size and growth have essential implications for the American economy and global financial stability. High debt levels can limit the government's ability to respond to future economic crises, as more of the budget is dedicated to interest payments. This could necessitate cuts in public services or increased taxes, negatively affecting economic growth. The high debt levels can cause concern about the American government's creditworthiness. Even though the U.S. has never defaulted on its debt, the perception of increased risk could result in higher interest rates and lower demand for U.S. Treasury securities. This would lead to more expensive borrowing and could cause broader financial instability. On a global scale, the American national debt is closely linked to the health of the international financial system. As the issuer of the world's reserve currency, the U.S. plays a central role in global trade and finance. Suppose confidence in the American government's ability to manage its debt is lost. In that case, it could have far-reaching consequences, such as disruptions in global financial markets and changes in currency reserves. Due to the scale of the debt and economic and political realities, fully repaying the American national debt is highly unlikely. However, the debt is manageable. The American government has significant tools to service its debt and maintain financial stability. The focus should be sustainable fiscal policies that balance economic growth with responsible debt management. Reducing the growth of the national debt will require difficult choices, such as potential tax increases, spending cuts, and reforms to entitlement programs. It will also require political will and cooperation, which have been lacking in recent years. While the debt may never be fully repaid, effectively managing it is crucial for the long-term health of the American economy and its role in the global financial system. Subscribe for more videos. Thank you.